In 1887, I saw a tough cowboy lose everything over a piece of shiny hope. Thought he'd dig up gold, ended up burying his future. Listen here, Hoss. I've been round long enough to know one truth. Folks don't lose money 'cause they're dumb. They lose it 'cause they chase what glitters. I saw it back in the dust storms of the 1890s, and I see it clear again in 2026. Same greed, new costume. Back then, it was a pickaxe and a dream. Now, it's a crypto wallet and a phone app. Ain't much changed, only the fools got faster Wi-Fi. When I rode up north to the Klondike in '96, the world had gone mad. More than 100,000 men and women left their farms, sold their horses, kissed their kids goodbye, all for the promise of easy gold. One strike and you're set for life, they said. But numbers don't lie, partner. Less than 1 in 100 actually found enough gold to cover the cost of the trip. The rest came home broke, frozen, or in a pine box. Now, stand that beside today's market circus. Between 2021 and 2025, millions chased crypto coins, meme stocks, even digital gold ETFs. They thought they were digging, but really, they were the dirt. According to Bloomberg, more than 74% of small crypto investors lost money after fees and inflation. Just like them Klondike dreamers, most folks thought they were buying gold, but what they really bought was a dream sold by someone smarter. Here's the trick, son. The system makes you feel like you're doing right. You read the articles, follow the experts, and maybe even own a fancy gold ETF. You figure you're protected. But take a closer look. That ETF don't hold gold for you. It holds paper, bank paper, tied up in contracts and brokerage accounts. You don't own metal. You own the idea of metal. Same way them old miners owned claims on land they never set foot on. Back in '96, I watched as them banker fellers rolled in with briefcases instead of pans. While the miners froze their tails off in the snow, those bankers bought gold nuggets for 30 cents on the dollar. They waited till spring, then sold 'em back in Seattle for full price. You tell me who found real gold, partner. The man swinging a pick or the man counting the receipts? And here's the bitter pill. It ain't just greed that ruins men. It's false security. Folks think they're safe 'cause the bank says so, or the app says insured. But every time you let someone else hold your wealth, you trade safety for convenience. In my day, that mistake cost a cowboy his horse. In your day, it'll cost you your retirement. So here's where we stand, 2026. Same dust, new boots. People out there chasing paper gold, digital gold, synthetic assets. Call it what you want. But I reckon 9 out of 10 will walk away empty-handed, just like the Klondike crowd. Only this time, you won't freeze in the Yukon. You'll just watch your savings melt on a screen. I ain't gonna give you the fix just yet, Hoss. Not till you see what caused this mess. Next time, I'll tell you why the game's rigged and how them banker fellers keep turning your sweat into their gold. Back in 1880, I watched banker fellers print paper faster than coyotes make pups, and every scrap of it was a promise they never planned to keep. Now lean in close, partner. You gotta understand something before we ride any further. Most folks don't lose because they're unlucky. They lose 'cause the game was built that way from the start. See, the house don't care how hard you play if the cards are stacked in its favor. In the 1880s, I rode into Dodge City with a pouch full of gold dust from Nevada. Figured I'd trade it for land. Banker smiled wide, handed me a stack of crisp notes. "Safer than keeping it under your saddle," he said. A month later, that bank folded. My notes weren't worth the paper they was printed on. The banker? He was halfway to Chicago with a new name and fresh boots. That's when I learned paper wealth belongs to the printer, not the holder. Fast forward to 2026. Different saddle, same saddle sores. Folks think they own their investments, but most don't even touch what they pay for. Your paycheck hits your account, your broker buys you an ETF, and your app shows you a number that looks mighty fine. But that number ain't yours. It's the bank's. You're just renting digits on a screen. And whenever that system hiccups, interest rates spike, liquidity dries up, a market freezes, millions lose before they can say, withdrawal pending. Here's the core of it, Hoss. The problem ain't the shiny stuff. Gold, crypto, stocks. The problem's structure. Regular folks' money flows through institutions that profit from your behavior. They charge when you buy, charge when you sell, and skim when you do nothing at all. Meanwhile, their own balance sheets grow fat because they lend your deposits 12 times over. That's not investment. That's alchemy, and you ain't the wizard. Take a look at your typical working man. He earns $3,000 a month, spends $2,800, and tucks the rest into savings that barely beat inflation. Over 5 years, he'll lose nearly 10% in purchasing power, even though he did everything right. Why? 'Cause standard advice keeps you tame. Save steadily. Diversify. Trust the system. That ain't guidance. That's domestication. I met a rancher's boy once in Texas. Smart kid, worked hard, put every spare dollar into a regular retirement fund. 20 years later, adjusted for inflation and management fees, he'd gained less than 1.8% a year. That was before taxes. Meanwhile, the same bankers who sold him those funds pulled in double-digit returns on leverage, using his savings as collateral. That right there's your modern version of the Klondike trick. You dig, they weigh. So, why do standard tips fail? Because they're written by the men who sell shovels, not the ones swinging them. Advice like, stay invested, buy the dip, trust the market. That keeps the system oiled for them, not safe for you. Nobody at the top wants you pulling your gold out of their vault. That's the real heart of this thing, partner. You can't win if you're playing on someone else's ranch. You gotta break free from their paper fences. But first, you need to learn how the pins were built. Next time, I'll tell you about the 5 mistakes I watched ruin good men, and why the dust still settles the same way today. In 1883, I watched 5 ranchers sell their horses to chase gold. Only one came back, and he was riding a mule he didn't own. I've seen the same story play out more times than I can count, partner. Doesn't matter if it's gold, oil, tech stocks, or crypto coins. Folks trip over the same 5 rakes every generation. The money changes its hat, but the fool wears the same one. Mistake 1. Chasing the shine instead of the numbers. Most folks don't invest. They gamble. They see a headline saying, price up 200%, and jump aboard like it's a runaway stagecoach. Trouble is, you never hear the story of the man who bought too late. Over the long haul, anyone who bought gold at the top of 2011 waited a full 12 years just to break even after inflation. Same with crypto. That 2021 buyer of Bitcoin at 60,000? He's still down more than 40% come 2026. The rush blinds him, same as the Yukon snow did. Mistake 2. Trustin' paper promises. Back in the Klondike, men swapped raw gold for paper certificates because it was safer. Banks defaulted and poof, fortunes gone by spring thaw. Today, folks stick their wealth in ETFs, or digital wallets that can freeze or vanish at the flick of a switch. One broker lockup, one platform hack, and a lifetime of savings turns to thin air. You don't own it if you can't touch it, son. That's the truth of both centuries. Mistake 3. Livin' wide, savin' narrow. A big paycheck don't mean freedom. It means bigger handcuffs if you don't manage it right. I've seen men pull 6 figures a year and die broke. Why? Expenses grow right next to income. A household earning $80,000 that spends $75,000 only saves $5,000 a year. At 3% inflation, in 20 years that savings loses half its buying power. Meanwhile, somebody earning $40,000 but saving $10,000, he ends up twice as far ahead. Ain't what you make, it's what you keep steady. Mistake 4. Thinking short, planning slow. Back home on the prairie, winter always caught the lazy. In finance, it's the same. No long-term map, no shelter. You jump from fad to fad, meme stocks, AI tokens, whatever TikTok yells next, and end up treading water for a lifetime. Miss just one bull run or panic sell once a decade, and your 10-year compound return drops from 8% to 3%. That gap turns $100,000 into $219,000 instead of $466,000. That's not a math trick. That's the cost of no patience. Mistake 5. Hand in control to someone else. Whether it's a bank manager, a robo-advisor, or some loudmouth on YouTube, too many folks let others steer their wagon. Every middleman takes a fee, a slice, or a secret edge. Over 20 years, even a small 1.5% annual fee eats away nearly 25% of a portfolio's total growth. That's your kid's college fund turned into somebody else's bonus check. Now don't you go thinking this is about income. It ain't. 2 men can ride the same trail with the same money. One ends rich in coin, the other in regrets. The difference ain't luck. It's the choices between chasin' and holdin', between seeing the glitter or measuring the ground. Every broken ranch I ever saw, every empty crypto wallet I hear about today, it starts with those 5 mistakes. Keep on that trail long enough, and in 10 years, you'll be saying, I did everything right, while staring at a balance that proves you didn't. But don't hang your head, hoss. There's a better way. One that kept my saddle and my gold safe through dust storms and depressions alike. Next, I'll show you how I did it. When the rush hit Alaska, I didn't chase gold. I sold shovels, weighed dust, and kept my own nuggets where no banker's hand could reach. Now let me tell you, partner, I don't preach miracles. I preach systems, steady, boring, built like a good fence. I've seen too many men try to lasso riches out of thin air. The trick ain't speed, it's control. You want wealth that lasts storms, wars, and crashes? You hold what's real, what don't vanish when the Wi-Fi flickers. Back in the 1890s, while the crowd ran north to dig, I stayed south and traded equipment. Every pickaxe I sold got me a fraction of their dream, but my earnings came steady, not in guesses. When I did take gold, I weighed it, stamped it, and kept it in my own safe saddlebag. That's the core of my system even now. Own the value directly, not through promises. Here's how it plays out today. Step 1. Get physical before digital. You don't need to hoard bars in a basement, but start building holdings that exist outside the banking web. That could be certified gold coins from trusted mints, silver rounds, or even a share in a private vault where you hold the key. When markets quake, and they always do, physical value stays put. During the 2008 meltdown, gold slipped only around 30% short-term before recovering, while stock portfolios dropped over 50% and took years to heal. Physical meant stability, paper meant panic. Step 2. Keep cash flow in tools, not toys. Every dollar you can deploy productively should earn, not just sit. I tell folks to think like I did in my shovel selling days. Buy assets that work. That can mean rental tools, online production gear, or dividend-earning shares you actually understand. If you can explain how the profit's made in one breath, it's safe enough. If you need a lawyer to explain it, it ain't. Step 3. Cut layers of trust. Each middleman between you and your money is a hole in your canteen. Use direct platforms, local credit unions, or brokers that give full asset custody in your name. Demand proof of reserve. Never forget, the more signatures on your wealth, the less of it's truly yours. Step 4. Protect liquidity. Hold 3 to 6 months' expenses in pure cash or hard metals. Ain't glamorous, but security rarely is. When recessions hit, like the one sniffing at 2026, folks with liquidity buy what panic sellers dump. The rich don't time crashes, they prepare for them. Step 5. Keep your head steady. A man who panics loses twice, first in money, then in peace. Build discipline first, wealth later. I check my assets once a month, not every hour. You can't grow a ranch by digging up the crops to see if they sprouted. See, this approach ain't flashy, but it's bulletproof. It don't rely on perfect luck, government rescue, or promises from Wall Street cowboys. It's steady because it's simple. You're replacing volatility with tangible value, short-term excitement with long-term control. In the old days, I called it owning what you can touch. Today, you might call it financial sovereignty. Either way, it's the same wild truth. Real freedom don't come from chasing more. It comes from needing less that can vanish. That's what's kept me solvent through droughts, panics, and 2 centuries of fancy scams. That's what I did, Hoss. That's what you ought to do. Keep your gold in your hand, your trust in yourself, and your future out of their papers. Boy, I rode through dust storms, panics, and one too many winters. Took me 50 years to learn. Freedom don't come from lucking out. It comes from sticking to a plan when the dust gets thick. Now that you know the traps and the tools, let's lay the map flat. I ain't talking dreams, I'm talking routine. You follow this trail, and time will do the heavy lifting. Year 1. Get your base solid. Start by knowing exactly what you own and what owns you. List every stream of income, every debt, every monthly leak. Keep 3 months survival cash or metals someplace you can reach without asking permission. Pull 10% of your income into hard savings monthly, half in physical value, half in build-up capital. Do that a full year and you'll feel something you ain't felt in a while. Control. Numbers stop bossing you when you start measuring them. Year 3 to 5. Build productive ground. Now you start sowing, not just stacking. Keep about 10 to 15% of your net worth in physical gold or silver. Small pieces, easy to trade or store. Push another 30% toward assets that earn while you sleep. Rental tools, small online ventures, dividend shares, land leases. Reinvest profits steady. Don't cash out because of noise. By year 5, inflation won't scare you because your income will rise on its own legs. You'll notice the bank's promises mean less, and your assets start speaking for themselves. Year 10. Ride independent. 10 years of that habit, and you ain't just surviving, you're owning your time. By now, at least half your wealth sits outside the reach of financial intermediaries. You live from your own yields, interest, rent, dividends, not a paycheck's mercy. Market crashes feel like sales, not crises. What changes most ain't your balance sheet, it's your pace. When folks rush for exits, you stay sittin' tall, 'cause you ain't chained to their paper storms. The core rules, short and steady. 1. Never buy what you don't understand. 2. Never store wealth where you need permission to touch it. 3. Make every dollar work, earn or defend. 4. Let compounding, not guesses, do the math. 5. Review yearly, not nightly, and adjust course simple. Following that don't make you rich overnight, but it makes you unbreakable over decades. When others swing between fear and FOMO, you'll be calm as dawn on a clear prairie, 'cause your fate ain't tied to their ticker. See, time's the best ranch hand a man's ever got. Give it discipline to work with, and it turns small piles into high ground. Neglect it, and it turns opportunities into dust. That's what I did, and that's what'll keep you steady. Gold in your hand, work you understand, and peace you can't buy from a broker. Ain't flashy, ain't fancy, but it's freedom, plain and simple.